Good evening and welcome to another ShareSoc webinar. This time our presenter is the Lowland Investment Company, and we have Foll, who is one of the two managers of the fund, with us this evening.
Hopefully everyone can hear me. I appreciate everyone who's listening. Hopefully we'll get some good questions towards the end. If we flick to the first slide, I'm going to start by talking about the UK equity market backdrop and the UK economic backdrop before I go on to Lowland, and then hopefully that will set the context for you. So in terms of the equity market backdrop, the chart on the left here shows how do UK equities trade relative to the rest of the world. And remember that the rest of the world these days is pretty US dominated. So in a way, you could think of this as a proxy for how does the UK trade relative to the US. And what the chart is showing is that UK equities, this thick line in the middle, normally trade at about 0.85 of what the world trades on. So about a 15% discount to the rest of the world. And then we get Brexit happening, no prizes for when this chart suddenly moves against us. We suddenly go from almost par to a 35% discount to the rest of the world, i.e. the US. So what the chart shows is that UK equities do normally trade slightly cheap relative to the rest of the world, about 15%, but now the figure is 35%. In other words, there's been this moment that's caused the UK equity market to move away from the rest of the world. Now, often when I show this chart, the next question I get is, yes, but the UK doesn't have any tech, which is a very fair point. And obviously our tech weight is very low. We basically have one large cap company called Sage, and that's pretty much it. But even when you look at each individual sector, the UK equity market screams cheap. So what the chart on the right is saying is, okay, just take it by sector and say, how does the UK trade relative to the US? And what it shows is that every single sector in the UK market is at a discount, obviously to varying degrees, with media at one end of the extremes and telcos barely trading at a discount, but there is a discount actually across every single sector. And to just sort of bring it to real life, I was sort of looking for this presentation to try and bring it home to people. If we look at something like a Tesco or a Sainsbury's, both of which we own in Lowland and have owned for a while, they would both be trading on, they've done perfectly well, they're both trading on sort of mid-teens type price to earnings multiple, which is, I think, good and fair. If you look at Walmart in the States, I always find this extremely surprising. Walmart is trading on roughly 40 times earnings. So that gives you a sense at that sort of retailer, fairly extreme end. At the more moderate end, you can see here consumer staples, it's saying here a 20% discount, or to sort of bring that home, if you look at Unilever in the UK, that's trading on roughly 17 times earnings, and P&G in the States would be trading at roughly 20 times to get you to that 20% discount. Now, you might think neither of those consumer staples companies looks particularly exciting, but there is a discount there with the UK versus the US. So to sort of frame, before we go on to talk about Lowland, the UK equity market is cheap, whether you just look at it as a market as a whole or whether you sector adjust it. If we then flick on one slide, so what are UK companies and specifically UK boards doing about it? So they can see, if you think you're sat around a boardroom table and you're running a UK PLC and you can see that your shares look lowly valued relative to overseas, something that you can pull, a lever that you can pull with, which is actually within your control, is to do a share buyback. So these companies can see that they get the same data as us that says flows are coming out of the UK. UK equity market has been an outflow since that Brexit date that I mentioned before. What can we do about that? Well, we can go out into the market and we can buy back our own shares. So they're still paying a good dividend. You can see here, UK market's paying about 3.5% yield. It has historically been a good income market, and it still is. But nowadays, not only that, but then we're also getting this buyback yield on top. So it's roughly the same if you think of 3% for each. So we're getting about 6% of the market cap back every year, split roughly half between dividend and buyback. And I think what often surprises people who are following the UK market, they might have picked up on this buyback trend, but it's extending further and further down the market cap scale. So even quite small companies that we hold in Lowland now are often doing a share buyback. And anyone who looks at the RNS announcements from the LSE, the London Stock Exchange, every morning, you will see just buyback announcement after buyback announcement. And that's company boards saying, look, we think shares are cheap. I think, you know, just to present the full picture, ideally, this wouldn't have to be the case. You know, ideally, UK companies wouldn't see their shares as supremely lowly valued, leaving them vulnerable, and I'll talk about that in a sec. Ideally, you would see more companies like Next. We don't actually own Next, but Next, obviously a very good historic performer, good allocators of capital, have come out and said we're stopping our share buyback because their shares have done really quite well and their rating has moved up to the point where they don't want to buy back their own shares. They want to allocate that cash elsewhere. It would be great to see that happening across the UK market, and I hope we see more of that. But for the time being, UK shares are lowly valued, and this is how companies are responding. If we flick on one more slide, this is why they're responding, because they feel vulnerable to being taken over. And these are the 5 takeovers that we've seen in Lowland in the financial year that just finished. Our financial year is to the end of September. You can see that in all cases, the premium of the takeover to the undisturbed share price was at least 25%, in some cases materially more, 50% in the case of Reynolds and H&T. And in each case, well, actually, in all, it's a mixture. Some of it's private equity, some of it's overseas buyers, but in all cases, there is a decent premium. And this is a reflection of that first chart that I showed you, that is the UK at this big discount. I mean, actually, a 50% premium sounds like a lot. In one case, elsewhere in the UK market, a company called Spectris, there was 100% premium, 100% bid premium. So if UK equity markets don't correct the valuation anomaly themselves, we will continue to see this heightened level of takeover activity, in my view. If we then flick on one slide, so that's the equity market backdrop. Shares are lowly valued, and they're trying to respond. You know, boards are trying to respond by pulling the levers that they can, but they are and do remain vulnerable to takeover activity for as long as that valuation anomaly is there. And what's the economic backdrop? Well, if we look at balance sheets for a sec before we come and talk about inflation and things, companies and consumers have paid down debt. So on the left here, you've got non-financial, i.e. non-bank companies. The dark line is debt relative to GDP. And it will come as no surprise to anyone, I don't think, that debt was building up ahead of the GFC. So you can see that dark line building up into the financial crisis. And then we've seen a long deleveraging trend since then. So since 2009 odd, companies have been steadily paying down debt, and in the green line, building up cash deposits. So you've seen this real conservatism on the part of UK companies in that post-crisis period. And the consumer has been, so the consumer's on the right-hand side here, the consumer's been exactly the same. They've paid down their mortgages, they paid down their credit cards. And you can, with the consumer, I think you can have a debate about the extent to which consumers actually chose to do this, or the extent to which the banks have been much more conservative in their lending and have kind of forced this on the consumer. But either way, the outcome is the same, in that there has been this really quite steep deleveraging in terms of both the corporates and the consumer. If I was watching this, I would rightly say, well, hang on a minute, you've missed one big balance sheet here, which is the government. So there's no chart of the government balance sheet. Your government debt to GDP has risen. It's risen to about 94% of GDP. But that wouldn't put the UK as a global outlier, certainly compared to the rest of the G7. There are plenty of countries in the G7 that have a public sector debt to GDP that's over 100% compared to our 94%. And I'm sure I'll get a question about the budget, but if we think about the budget as needing to raise, say, 30 billion, if market estimates are right, 30 billion pounds, if market estimates are right, the UK economy is just under 3 trillion. So 30 billion, if done in a sensible, non-inflationary way, should not be enough to derail a roughly 3 trillion pound economy. Obviously, we have to wait and see what they actually announce. But just looking at the numbers alone, it shouldn't be enough to derail the economy. If we flick on one slide and talk a bit about inflation, we can see here, so on the left-hand side, we've got the labour market. And what the chart is basically getting at is that the labour market is easing. So we've seen unemployment tick up, we've seen vacancies normalise, we're increasingly seeing private sector pay settlements moderate, the public sector to follow, but private sector pay settlements are around the 4% range. Public sector is still 6%, that probably does need to come down. But what that allows is that at the time of filming, we've got a Bank of England meeting later on this week, and it's pretty much on a knife edge. Interest rates should be able to come down. We are seeing that labour market normalise. Inflation was expected to tick up last month. It didn't. It held flat at 3.8. That probably creates the path downwards. You can see on the chart on the right as we head into next year. So whether or not we get a rate cut at this week's meeting, again, we're filming in early November, I don't know, but I think the door is open to a December cut potentially, and certainly as we look into next year. And so that should, the Bank of England are very clear, all economists you speak to are clear, the base rate at 4% at the moment is a restrictive policy. If we see that rate come down, it should hopefully provide a modest, and I do mean modest, impetus for the economy to kick on. And then final slide on the UK economy, if we look at GDP growth, the UK here is the sort of short green line on the left. What it's getting at is that UK GDP growth, aside from obviously the anomaly of China, is very much just in the pack with peers. So actually the US is the one that often surprises people on this chart, that the US growth rate is no longer exceptional, it's within the pack. So UK versus US GDP growth, there's really very little in it. And yet if we think back to that equity market valuation chart right at the beginning, there's a lot of difference in valuation and not a lot of difference in terms of growth. Where the UK has historically held itself back, in my opinion, and this isn't to say there's not other underlying problems like productivity and energy costs, and in no way denying that, but confidence has been a problem in the UK in recent years. We've had 2 successive years when the budget has created this uncertainty, this overhang. And it's reflected in surveys in that businesses don't quite know what to say. So what I mean by that is, if you look at the green line on the right-hand chart, the Lloyd's Business Survey, this is businesses being asked, how do you think your business is doing? And they say, actually, I think my business is doing okay. But then if you ask them, well, what do you think? The CBI is more a reflection of, what do you think about the NI increases that you've had as a business? What do you think about the national living wage increases that you've had as a business? You get a more negative response as an understandable reflection of some of the costs that have been put on businesses. So there is this mixed confidence response. But if we get through the other side of the budget, as I said, without more inflationary policies, if we're heading into more interest rate cuts, I think that will be enough to give that modest, and again, I do mean modest, impetus to the economy. So the overall, before we go on to talk about Lowland, the overall message that I wanted to get across is the equity market, the UK equity market, is an outlier in terms of its valuation, but the UK economy isn't. As in, if you look at this GDP graph, you think, okay, the UK is just kind of in the pack. Yes, it's not stellar, but there's nothing particularly bad about it. Whereas you would think that if you looked at some of the equity market valuations. So if we now flick on, let's talk about Lowland. So Lowland sits in the UK income sector, but it's a different kind of trust because it goes all the way down the market cap scale to smaller companies, those on AIM, those on the FTSE Small Cap Index, those on FTSE 250. So the reason that I spent some time talking about the UK economy is that the UK economy matters more to Lowland with its small and mid-cap focus than it would if I were running a larger cap trust. So those larger companies, say the top 20 in the FTSE 100, the AstraZenecas, the HSBCs of the world, they're very international businesses. It wouldn't necessarily matter too much for them whether UK GDP growth is 1.1, 1.2, what happens to UK base rates. Whereas for Lowland, if you drill down into the portfolio, roughly 55% of the portfolio sales of Lowland are in the UK. Whereas that benchmark, that very international larger company benchmark, is more like 25%. So you could think of Lowland, if you wanted to think of it this way, as being about 30% overexposed to domestic UK. So that's why I spent that time giving the context that actually the UK economy is not so bad, that consumers and businesses have good balance sheets, because it matters for Lowland. And what the chart is trying to get at, the sort of pie chart here, is that if you think of the sort of traditional UK income stocks, and for this I've just done a very sort of finger and air proxy and said, look, it needs to have a market cap of over £1 billion, it needs to have a dividend yield of over 3%. That's roughly 40% of Lowland. So 40% of Lowland will have a decent crossover with the rest of the sector that's owning large cap companies, most of which we've probably heard of, you know, the banks, I've given Sainsbury's here. But then the other 60% of Lowland is more different and is often companies, you know, maybe there'll be people on the call that know Elementis and Vanquis and Norcross, but a lot of them at a guess might not. And that's 60% of Lowland. So it is more different. We do go down the market cap scale. And the reason for that, you know, the advantage that we think that brings to our shareholders is that historically, those small and medium-sized companies grow faster. They grow sales faster, earnings faster, and therefore dividends faster. I'll show you the Lowland dividend CAGR as a result of that in a minute. And it also makes mine and James, so I run this alongside James Henderson, and it makes our life easier because less people are looking at those smaller companies. So it's easier if we go out, we meet the management team, you know, we do a site visit, spend time with them, to add value in those smaller companies than it is in Sainsbury's or the banks, where you've got, you know, hundreds of people realistically looking at those companies. So that's why we have that multi-cap focus. And in terms of the outcome for our shareholders, if we look at this sort of table on the right shows what's driven the relative performance over the last 5 years, and I'll give you the numbers in a minute. But some of the stocks you can see listed here are very much traditional UK income stocks. So the likes of NatWest, the likes of Aviva, Standard Chartered probably would be in a lot of large cap income funds. But then you can also see much more unusual names. So something like Renault, which was, it's actually been taken over now, but it was an industrial chain manufacturer. You know, FBD, which is an Irish, largely agricultural insurer. Even the likes of M&S. M&S has only recently come back to paying a dividend, and a relatively small one. So it wouldn't have been on the list for many income funds. So hopefully it gets across that, yes, Lowland has this traditional income element to it, but it also has more unusual smaller company names in there as well that have contributed positively to performance over time. If we then flick on just a few, you know, very basic facts about Lowland, it's about 350 million of net assets. It's trading at about a 10% discount at the moment. That's reasonably unusual, but the way it tends to trade, just so that people have the context, is that people who invest in Lowland tend to know that it is this proxy between larger companies and small and mid cap. So it tends to trade almost 50-50 between the AIC UK income sector and the AIC UK smaller company sector. And the smaller company sector at the moment is trading at, from memory, a low teens discount. So the UK income sector is trading at 4%. The UK smaller companies is 11%, and Lowland tends to trade roughly as a proxy between those two things. So we're probably trading slightly wider than that would suggest, but I think that's probably a reflection of appetite for UK equities, and particularly more domestic ones at the moment. And then just broadly in terms of how we run it, 70% roughly active share. All that tells you is that the portfolio is roughly 70% different from the benchmark. In other words, it is pretty different from its FTSE All-Share benchmark. It has a lot more in small and medium-sized companies. We are not a dividend hero. The board will understandably be frustrated that is because we held the dividend flat 1 year during the financial crisis. Otherwise, we would be a dividend hero. Since the trust was founded in the early 1960s, the dividend has never been cut. And as of today, the dividend is around 4.2%. And we use gearing. We think it's one of the key advantages of the investment trust structure. It's contributed positively to performance over time. That gearing is structured as a mixture of some long-dated debt that we've got into the mid-2030s and a revolving credit facility. If we flick on, just a bit about the investment process, and I recognise this is a very whistle-stop tour, but at the beginning we mentioned this is a very much a valuation-driven process. We're looking for companies that are trading at a discount either to their peer group or to their history, but there isn't just one value metric that we're using. We're not sort of screening the whole market for price to earnings. We're using different metrics for different companies. So I've given 3 examples here because we're using different metrics for each of them. So for Aberdeen, which we've bought within the last, certainly the last 18 months, but it's probably more recent than that, last year, we've bought that on the basis that Interactive Investor, so Interactive Investor as a platform is wholly owned by Aberdeen. So we are valuing Aberdeen on the basis of a sum of the parts, so taking each of the individual divisions and saying what we think they're worth. So it was some of the parts that drove us towards Aberdeen. In the case of Vesuvius, which is a steel consumables company, it was EV sales. So EV is market cap adjusted for debt and just comparing it to the turnover of the company. And in that case, you were paying less than £1 for each pound of sales. And that would suggest, and for a company that's talking about making a teens margin, we thought that looked attractive. And then in the case of Norcross, which is bathroom supplies, it's almost like a Howdens, but for bathrooms rather than kitchens. It's a much smaller company. It's the UK market leader in bathroom supplies. That's on price to earnings. That's trading on roughly 8 times, maybe even a little bit less forward earnings, which in our view looked attractive for a UK market leader in what it does. So it is value as a process, but it's not one metric across the whole market. We don't think that works. You have to be bespoke. And we're paying attention to individual companies and looking for what we see as valuation anomalies. And then the next step is meeting management. We spend a lot of time meeting, and I'm not talking to investors, talking to individual company managements. We probably meet several per week. We would do hundreds and hundreds of company meetings a year. For smaller companies, management team is absolutely key. Probably less so, not to say that large company CEOs don't do a good job, I'm sure they absolutely do, but the CEO and CFO at the smaller company level are crucial in driving that business forward. So we want to spend a lot of time with them. And at the smaller company end, we wouldn't buy a position until spending time with management. In terms of how we construct the portfolio, we tend to start small. We'll often buy around a 0.3% position when we've done that initial management meeting and got comfortable with the holding. And then we will build it from there, because we do tend to be more contrarian, and we're often buying things when not every box has been ticked, but we think that on balance of probability, the shares are too cheap. So we will start small and then we will gradually build. And then at the other end, we're also going slowly. So when we think things might be reaching fair value, I've mentioned the food retailers a bit, things like Tesco and Sainsbury's, we are now gradually reducing those following a period of good performance and re-rating, but we're not coming in on one day and going, we'll sell the lot. We're gradually reducing and finding new opportunities at the other end. And that lends itself to a long list. So for exactly that reason, we've got just over 100 holdings. That's very usual for Lowland, because of exactly the process that I described, and that hasn't changed over time. If we then click on, so sort of what's that driven in terms of performance? These numbers to the end of August, but it wouldn't look too different to the end of September or October. The trust has outperformed. It's got a FTSE All-Share benchmark, which we recognise is not maybe the perfect benchmark, but is possibly the least worst option. And it's outperformed the benchmark year to date and over 1, 3, 5 and 25. You'll notice that I didn't say 10 there for the eagle-eyed, and that's because the 10-year number captures that de-rating period after Brexit, when Lowland was hit more than its peers, because Lowland has more, as hopefully I've got across, it has more in the domestic economy. So when Brexit happened, we didn't expect it, the market didn't expect it. Those domestic companies de-rated more than the biggest companies in the FTSE 100, which tend to be more international. So that hit Lowland more than our peers and our benchmark. So the 10-year is behind, but 1, 3, 5 we're very pleased with, as well as 25. Obviously, I can't take credit for the 25. If James were here, James had been running the trust since 1990, so he definitely can. What's driven the 1, 3, 5? It hasn't been smaller mid-cap. Smaller mid-cap, actually, the wind has been in our face in that smaller mid-cap has underperformed over that time period. What's driven the 1, 3, 5 has been stock selection. Things like M&S have performed well, things like Babcock in defence, and we've also had quite a number of takeovers. And takeovers, so of all the portfolios that I manage, Lowland does tend to be the most exposed to takeovers, and I'll very briefly try and explain why. And it's because we're looking for small and medium-sized companies that are paying a dividend and are therefore quite established and cash generative. And if that creates a pool that we're looking in, and in a way we're thinking about those companies in a similar way to private equity. So it often means that the pool that we fish in has quite an overlap with private equity companies that are looking to buy often those cash generative, quite conservatively leveraged companies. They buy it they often put more debt in order to get the cash out. So we're thinking in a way similarly to private equity, and it means that Lowland, people often say, well, it's a takeover, it's not repeatable, but actually Lowland in almost every year does have several takeovers because we're thinking in that way. If we then flick on, just talk about dividends briefly, we can go back to the early 90s. It's grown at 7% CAGR. You can see that it did clearly slow in that post-COVID period because we went through steep dividend cuts, particularly in smaller companies in that COVID period. And then at a trust level, we were effectively growing back into the dividend for a couple of years after that. We are now fully covering the dividend again. For those that have been following the trust closely, we have done a share buyback of roughly 20% of the company over the last 12 months. That has been earnings accretive, and we will see the full benefits of that in the financial year that has just started now. So we are positive on the outlook for dividend growth because we can see that that buyback has been accretive in the year that we're in right now. If we flick on, I think we've covered this a bit, the trust is at a discount. The yield at the moment is actually more like 4.2% following some decent performance. That's the P of the portfolio as at the end of August. If I update it to today, the market, I mean, to be honest, it hasn't moved hugely, but this is as of Friday, the portfolio P is on 12-ish and the benchmark's on more like 14. So if we think back to the very beginning, look, the UK market is at a discount compared to overseas, and Lowland is at a discount to the UK, and the Lowland Trust is at a discount. So basically there's multiple layers. So UK market is at a discount, portfolio is at a discount, the trust is at a discount. There's multiple layers of discount there if you sort of work your way down the chain. If we then flick on, we might have covered this already, like small and mid cap. The UK is cheap, small and mid cap is cheaper, effectively. AIM in particular has been a real source of underperformance in recent years, but probably less appreciated. The FTSE 250 has done pretty poorly. I mean, even this is a 3-year time horizon, but even this calendar year, the FTSE 250 is underperformed by roughly 10% compared to the FTSE 100. So there has been a meaningful headwind for small and medium-sized companies. And coming back to the economy, I think what it probably needs, or what it could potentially need, is for interest rates to come down and for confidence to be restored. I think that would help some of those smaller companies. If we then flick on, and this chart is really to address a question I often get about the UK, which is, does the UK have good companies? Does it have a Nvidia? Does it have a Nvidia? I think the answer is no. Does it have good companies? Yes, but they look different to a Nvidia. What the UK, I think, has good companies in is compounders, companies that can perform well over the very long term as they continue investing. So Cranswick, for context, so both of these companies are in Lowland. Cranswick is pork and poultry processing. Hill & Smith is galvanizing, i.e. dipping things in zinc to stop them from rusting. If you ask someone, what do you think the best performing shares that you've got are, you probably wouldn't say pork, poultry, dipping things in zinc. But these companies have taken very normal business models and turned them into extraordinary returns. We've got £1 here going to £8-9 in both cases over the long term. And they haven't done that through blowing the lights out in any one year. They've done it through gradually investing. So someone like Cranswick invests comfortably over 100 million every year in their capex. They've grown in pork, now they're growing in chicken, they'll grow in pet food. Hill & Smith have added galvanizing sites over time. Sometimes they've bought them, sometimes they've done a greenfield and done them themselves, but they've kept investing every single year. So it's that compounding type of pretty normal business. No disintermediation by tech. I think we'll all need to eat chicken, and we'll probably need to stop things from rusting, which I like, and I like that about both these businesses. So you can get very good returns from normal businesses run well, and I think that's what the UK market does well. If we then flick on, we've tried to give a couple of examples here of companies that we're adding to across the market cap spectrum, because sometimes people's eyes can just be drawn to large cap, and we wanted to give a couple of smaller company examples as well. I've been through a couple of these already. Maybe one I haven't mentioned, something like a card factory that normally raises an eyebrow because people have often been in the shops. It's trading on 7 times earnings. It's actually more like 6 times forward. It's paying a roughly 6% dividend yield that's covered. Management team are very in my opinion, good and experienced retailers. They've recently bought Funky Pigeon from M&S WH Smith, which gives them a good online offering, which they were historically lacking in. So these are the kinds of opportunities that we're trying to find. It's pretty low down the market cap scale, but it's in my view, a well-run business with scope for growth now online, that's not reflected in 6-7 times PE and a roughly 6% dividend yield. If we then flick on, this is more for questions at the end if anyone wanted to ask me, but hopefully the top 20 gets across that, yes, there's some traditional UK income stocks in there, the likes of HSBC, the likes of BP and Shell, GSK, but there's also some much more unusual names in there that would not traditionally be held in an income fund. Something like Irish Continental, which is a ferry company between Holyhead and Dublin, something like Senior, which is commercial aerospace components, things like Serica Energy, which is a North Sea oil and gas company. So hopefully that gets across. Yes, there's large cap in there, but it's a real blend of small and mid as well. And then just to finish off, and I'll hopefully have some questions if we flick to the next slide. The UK market's at a discount, just think about the layers of discount that I kind of went through. The UK market's at a discount, this portfolio is at a discount, and it's trading at a trust level at a discount as well. So there's 3 layers of discounts in there. And then if I was to think about where within the UK market I think the opportunity is strongest, the FTSE 100 in particular, the FTSE top 20, has performed very well. And I think if I were to say, look, where in the UK market do I think is most attractive, I think despite the budget overhang, etc., I would point more towards the domestic smaller company end. That is the area that's underperformed. There's often, like I said, very traditional but well-run, conservatively managed companies in there that aren't getting that much attention at the moment. And the trust structure is better for that. It's challenging to hold more illiquid shares within an open-ended vehicle, but with a trust structure is well suited to owning that more smaller illiquid domestic company. So I'll finish there and hopefully we'll have some questions.
Thank you very much indeed, Laura. I have to say that's quite compelling, with 3 layers of discount sitting on top of 5 years of outperformance, not only of the FTSE All-Share, but also of the equity income peer group on the AIC. So generally one sees strong medium-term performance associated with high valuations rather than low valuations. So that's looking interesting. Question from the audience: is the increase in takeovers, and you sort of addressed this, allied to the lack of IPOs, posing a problem for you? Are you struggling to find new companies to invest in?
Yeah, it's a very, very good question. And it's what I'm spending most of my time on at the moment. So those 5 companies that I put up, these are the ones that have been taken over recently. We've spent a long time getting to know those companies. Something like an Epwin, which still makes door and window frames. We bought that company at IPO, and I have met that CEO countless times. So now it's about finding a replacement for that idea, and realistically, and being very upfront, that takes time. We don't want to rush into new ideas. I've got a long list of companies that I'm working through at the moment, some of which have now made it into the fund as that starter kind of 0.3% position, some of which I'm still doing some work on. I'm not struggling to fill the hopper, but I don't want to see this trend go on for years. So at the moment, am I struggling? No. But I think, again, I always want to be upfront. If we were to see this carry on, the pool is shrinking. No one can deny that. There aren't the IPOs that are coming. They're few and far between, and we haven't participated in any of the IPOs. They're not quite our kind of company yet. Hopefully we will see some that are our type of company. So I wouldn't want to carry on. I'm not struggling right now, but I wouldn't want it to carry on. That's why I say hopefully we do see companies see their valuations go up, and we do see things like companies stopping a buyback. I really hope that is the outcome. So no for now, but it is a worry for the future.
Thank you. And related to that, we're seeing quite a lot of delistings, sometimes delistings sort of looking more like a takeover, but effectively it's management and it's a funder. Those are problematic particularly where they're sort of coercive in nature. They're problematic for individual investors. They're not necessarily problematic for an investment company because you can track those investments into private space. It's not something that you've done. You've got near zero private at this stage. Is that a thought process?
So we haven't held any companies that have chosen. I mean, I think the first thing to say is it's very few and far between. I mean, most of the times when we see delistings, it's, you know, to go onto the New York Stock Exchange or something and try and get an arbitrage on that. Very, very rarely do we see companies delist and go into the private space. But obviously, at the very small cap end, you do occasionally see that. We would not think kindly on that. Obviously, that takes away the liquidity for investors, and generally the reception tends to be very negative. So where the free float is high enough, hopefully shareholders would have the ability to vote against, and we would certainly do that. So no, we have a very, very small weight in private companies. We have one in Oxford Science Enterprises, which is effectively it's like IP Group. For anyone that knows IP Group, it invests in portfolio companies from Oxford University. So it has a quarterly published NAV, which helps value it, and it's very small in the trust overall. And then we have, I think this goes back to the 1960s, but James would know if he was here. We have one holding in Wadworth, which is a pub group, but both of those unlisted would be comfortably under 1% of the trust, and we wouldn't have any intention to add to the private weighting.
Thank you. Wadworth has come across my screen recently as a company that's not very forthcoming with information to its investors. So question from the audience, could you talk us through what additional resources are available to you at Janus Henderson? Do you have a team feeding ideas to you? And I'd also like to add on to that, if you could run us through the decision process between yourself, James, and any others.
Yeah, so on the team so it's James and I that run the fund as the two fund managers. In terms of the wider team, I sit on what's called the Global Equity Income team at Henderson. It used to be the Value and Income team. I think some people on the call would probably know some of the other fund managers on the team. So I sit next to Joe Curtis, who runs City of London. Also on the team would be the likes of Alex Crook, who runs Bankers Investment Trust. We'd have Ben Lofthouse, who until recently run Henderson International Income Trust. So there's a lot of investment trust experience on the desk. There's 12 of us. Some are analysts, some are fund managers. So there's a support. So beyond just me and James, there's a couple of analysts and a lot of very experienced UK equity income fund managers on the desk. And then beyond that is clearly broader Janus Henderson, where we have sector-specific analysts covering every global sector, whether it's financial, pharmaceuticals, etc. We don't have to follow their recommendation, and they don't tend to cover down the market cap scale. So they would have a view on GSK, AstraZeneca. They wouldn't have a view on Marshalls, Ibstock, sort of smaller companies. So that when it comes to the smaller companies, it would be more me, James, some of the analysts on the desk, and then we also have a smaller companies team at Janus Henderson who run Henderson Smaller Companies Investment Trusts, and that would be Indri Van Heen and Shiv, for anyone that knows that team. So there's a huge depth of coverage at Janus Henderson beyond just me and James, who are the portfolio managers. In terms of the actual day-to-day, who is making the decisions, it is me and James. So we would talk, we loosely have sector coverage between the two of us. James would know insurance fantastically well. I would tend to cover more consumer, pharmaceuticals, sometimes industrials. So we tend to split sectors between the two of us, but it's ultimately the two of us that make the decision with the use of this broader team.
Thank you very much. And another question is how the investment trust structure lends itself to your portfolio? How much further down the market's cap spectrum can you invest because of your investment trust?
Yeah, it's a very good question. We can go significantly further down the market cap scale being an investment trust than we would be able to in an open fund. So open-ended funds, for completely understandable reasons, very legitimate reasons, as a result of the structure, can't generally these days go beyond a certain market cap level, whereas we can in investment trust. We know that we've got a fixed pool of capital. So it's a real, if you think that the smaller company end of the UK market is where the value is, it doesn't have to be Lowland, but an investment trust structure is better to be able to take advantage of that than an open-ended fund. And then there are other more structural advantages of income, so you can make your income a lot more predictable if you're in a trust structure, and gearing, I think you can make better use of gearing. So there are, in my view, there are a number of advantages to the investment trust structure, and the ability to hold a liquid is certainly one of them.
Thank you. And you mentioned that many companies are buying back shares. If they're prioritizing buybacks over dividend growth, is this inhibiting LWI's ability to grow its dividend?
Again, a really, really good question. So what we're seeing is that special dividends are not always, but often dropping off. So it's not that companies are cutting their ordinary dividends to pay a buyback. It's that they're special that would often give us a sort of buffer to put into the revenue reserve is falling. We have had a small amount of special dividends from the occasional share like Dunelm, but it is pretty few and far between actually. And most companies, the likes of the non-life insurers would historically have been a good source of specials for Lowland and no longer. So we've got the benefit of the accretion from that share buyback that we did earlier on in the year. And it's, the board make the dividend decision, not me, but if I were the board, I would say, look, I'm going to bank some of that and maybe spread it over a couple of years, thinking that those specials, well, unless the valuation of the UK market suddenly changes, which would be great, but I think we will probably not see those specials come back in a meaningful way for a while. So I might look to spread that over a couple of years, that buyback accretion.
And a related question, I'm not sure I understand entirely. Hi, can I ask what Laura's view is of enhancement to the dividend payment?
Yeah, so I'm guessing, and the person can write if I haven't read that correctly, whether we distribute out of capital, because you are seeing some of our peer group pay an enhanced dividend that's effectively just a capital distribution. I don't agree with that as a policy. And the context for that is that during COVID, Lowland did pay out of capital because we saw smaller companies cut their dividends roughly 50% during that COVID period. So we were paying out of capital at that point. And the reality of paying out of capital is that you are going through the portfolio all the time thinking, what do I need to sell to pay that dividend? So people have a view of revenue reserve, of it's a sort of pot of cash over here that you're paying out of. Well, the reality is that dividends are cash payments going out the door. And in order to fund them, if you're paying them out of capital, you're constantly going through the portfolio selling in a way that you wouldn't otherwise do. And I think doing that for Lowland I'm not saying it's the wrong thing to do, but it did definitely set us back because we were forced to sell some things that went on to perform very well after COVID. We all saw the market rally that happened after COVID. So I'm not in favour of doing that. The dividend is a natural dividend that comes from the income from the portfolio. Hopefully that's clear, and hopefully that answers the question.
It does. I got a yes, but there's a follow-on which says, but if buybacks and dividends bring in 6% as mentioned earlier, how would shareholders benefit from the buybacks?
Yeah. So the way shareholders benefit from buybacks is that the EPS growth should be higher over time. So those companies, in buying back their own shares, they're shrinking their share count. So your EPS growth should go up. So the value of the company. So effectively, you get it back in, all being well, you get it back in capital rather than dividends, because that company, for each individual shareholder that didn't choose to sell into a buyback, that company is worth more for you. So you should see it in the price rather than the dividend.
Thank you. You mentioned earlier on all the portfolios that I manage. You're spread across how many trusts or portfolios?
So the other trust that I manage, again, alongside James, exactly the same structure, is Lord Venture. Okay. And then I also manage an open-ended fund, which is relatively small, called Henderson UK Equity Income and Growth. Okay.
Yes. I sat on a panel with you for when you were representing Lord Venture, so I knew that answer. Can you talk a little bit about portfolio? I believe you're about 80 to 90 holdings, just concentration and conviction.
The holding number is roughly 100, just over. That's very usual for this trust. This isn't a conviction. I don't want to give anyone the wrong impression. We do not run this as a conviction portfolio, and that's very deliberate. Conviction portfolios obviously work very well for a certain type of fund manager, but being contrarian and value, when we're buying some of these smaller companies, use something like a card factory. We would not want to put 2 or 3% of the fund in that holding. And I don't think it would be appropriate actually from a risk perspective to do that. We are buying companies where there are question marks about it. And that's why we think that on balance, the shares are too cheap, but that's why they are trading cheaply. And so, as I said, there are portfolios that are more going after quality, compounders that can hold a short list. That's not how we run the fund, and I wouldn't anticipate that changing.
Fantastic. I've got a last question that's popped in. How high would you run up a holding? Do you have a hard rule on trimming?
There's no hard rule, and it tends to vary with the size of company. So something like HSBC, which is the big, HSBC is a roughly 5% holding at the moment. We tend not to go above 5, but 5 is obviously quite a large holding. But the HSBC in our benchmark is 7. So we would let something like HSBC get to 5. The direction of travel for that would be down rather than up. But for a small and medium-sized company, we wouldn't let it go through 3. And at 2, we'd give it a good review. But it does depend on the size of the company.
Fantastic. Thank you. I have no more questions on screen, and I've run out of my scribbles. So, Laura, thank you very much indeed. That's a fantastic presentation. As I say, very impressive performance history and valuation. So, looking interesting.
Thanks for having me.
Thank you.